If you're an Edexcel A-Level Business student looking for a video to revise all of Theme 3.5 Assessing Competitiveness, well, this video is for you, because we're going to go through everything that you need to know for your exams, including what is an income statement and a balance sheet. We'll also go through some key calculations such as the gearing ratio and return on capital employed. Then we'll take a look at some key HR performance metrics, including strategies of how to improve these. Let's get into it. Now, the first thing that we need to do in this revision video is to understand what an income statement is. Now, we have gone through income statements and balance sheets earlier on in Theme 2, but for the calculations of the gearing and return on capital employed, we really need to know what these are in a lot of detail. So on the screen here, you can see what an income statement would look like. Now, essentially, these are financial documents that show the business's revenue, expenses, and profit or loss, of course, if we don't make any, over a specific period in time. Now, with the income statement, it is also known as the profit and loss statement because it shows the business's profit and loss. Now, remember, there are three types of profit that we have. Remember the acronym GON, G-O-N. Goes gross profit, operating profit, then our net profit. Now I'm just going to quickly break down each of these sections. I'm not going to go into too much detail with them though. First of all, we've got the company's revenue, of course the money that we make from selling our products or services. And the way we calculate this, we take the selling price times by the quantity sold. Then we have our cost of sales. Now these are the direct costs involved with producing a product or service. And that will typically include your raw materials, packaging costs, and also the direct labour. Direct labour being the employee costs of people who are directly involved with making that product. Then we've got our operating expenses, which are the indirect costs. So these aren't directly involved in making the product, they're more so involved with the day-to-day operations of the business, sort of like our fixed costs. You know, we've got stuff like our salaries and wages of employees who aren't directly involved with making the product or service. We've got our marketing, our rent, our research and development, utilities, and so much more. And then we have our finance costs. Now, these are the expenses incurred by a business for borrowing money, such as interest paid on loans, overdrafts, or bonds. So as we know, the interest rates are the cost of borrowing. Now, that would be added into our finance costs here. And then we have our taxation. Now, if you are a sole trader, you'd pay income tax rates. But if you are a limited or public limited company, you would pay the corporation tax rate, which at the moment in time is 25% within the UK. And just a couple key calculations that we need to do to calculate the different types of profit. Starting off with gross profit, remember to follow the acronym GON, G-O-N. So the way we calculate our gross profit is that we take our revenue minus our cost of sales. So in 2023 here, we can see the business made a revenue of £10 million. Your cost of sales is only £6 million. Therefore, the gross profit would be £4 million, 10 minus 6 mil. And then we have our operating profit. Now, the way we calculate our operating profit is we take the gross profit minus your operating expenses. So the operating profit shows the profit of the company after you deduct the direct and the indirect expenses. So here on the example, 2023, we just calculated a gross profit of £4 million. Our operating expenses are £2 million. Therefore, 4 mil minus 2 mil gives me an operating profit of £2 million. And then we do the net profit before tax. So we're not deducting tax at this point. We would do our operating profit minus your finance costs. Now in this situation, operating profit is 2 mil, finance cost is £500,000, which would give me a net profit before tax of 1.5 million. And then we do the net profit after tax. As we said, taxation, corporate tax in the UK at the moment is around 25%. So we figure what 25% is of our net profit before tax, which is going to be £375,000. So we do the 1.5 mil minus £375,000, which would get me a net profit after tax of £1,125,000. Now with the net profit after tax, I can take that and pay my shareholders in the form of dividends, or I can reinvest that back into the business. The next topic that we're going to take a look at in this revision video will be our balance sheet. Now, once again, we've already done balance sheets in Theme 2 because we had to calculate the current ratio. But as I said, we do need to recap what a balance sheet is, especially for calculating capital employed, return on capital employed, and our gearing ratio. Now, a balance sheet is also known as a statement of financial position. And essentially, it's a snapshot of the business's financial position, covering three different aspects: the assets, liabilities, and equity. Now, assets is what the business owns. Liabilities is what the business owes, and equity is when we take our assets minus the liabilities, and whatever is left over is equal to our equity. But we've got two examples. We've got share capital and retained earnings. More on that in just a moment. Now, why is it called a balance sheet? Well, it's because it balances. Our assets are equal to your liabilities plus your equity. And another important formula is also our net assets. The way we calculate that is our total assets minus our total liabilities, also the same as our equity. Now, when we look at our assets and our liabilities, these can be broken down into two further categories. We have our current assets and our non-current assets. Easy way to remember what the difference is between these two: current within 12 months, non-current after 12 months. Keep that one in mind. Now let's break down all of the different aspects on the balance sheet, starting off with our current assets. Now, as we say, current within 12 months, assets, things that we own. Now, what we want to do with our current assets is that we want to take them and convert them into cash or use them up within the next 12 months, within the next year. And I'm going to quickly explain all the different type of current assets we typically see on the balance sheet. First of all, you've got your cash and cash equivalents. This is your most liquid asset. It's what you use to pay the bills with. It's money in your pocket, it's money in your bank account. And then we've got our inventory, which covers three different things. First of all, it's the raw materials that we use to make the product. The second is our work in progress goods. So the product is going through the production line, it's 50% or 60% completed. And then we've got our finished goods, our stock that is waiting to be sold. Next up we have is our trade receivables. Now, your trade receivables is the money that you're waiting to receive from your customers who have bought product or services on credit. So for example, if I've sold a TV worth £1,000 and the customers only paid £250 today, well, they still owe me £750. That would be recorded as a trade receivable because we are waiting to receive that money. And then we've got any prepaid expenses. So I've got ahead on some expenses such as my rent for the month, but I've not yet experienced it. So if we were in the month of January, I've already prepaid the February month's worth of rent. Next up we have is our non-current assets. Once again, these are still items that the business own, but this time for longer than 12 months. So realistically, what the business wants to do with these non-current assets is to generate some economic benefits from. And we tend to keep them for longer than 12 months. So we don't just bring in these non-current assets to sell straight away. And this can also be called your fixed asset, and they can be broken down into tangible or intangible. Tangible, things that you can touch. Intangible, things that you can't touch. Now, some examples that we have. First of all, property, plant and equipment. So this could just be any equipment you use in the production process, any buildings that you own, any vehicles as well. The next one we have is something called goodwill. Now, this isn't a lad called Will who's done something good or has done well in his A-level business exams. But goodwill is when we've acquired a different company and we've paid more than their net assets. So this is showing any intangible benefits that the business had, such as good reputation and good customer loyalty. And then we have any other investments, which could just mean we own shares in a different company. Next up we have is our current liabilities. Now remember, liabilities is debt that the business owes. Current within 12 months, put them together, is any debt that the business owes within the next 12 months. So the different type of current liabilities we have, first of all, is trade payables. Now remember, trade receivables is the money we're waiting to receive from our customers. But when we think about trade payables as a debt that we owe in the next 12 months, well, this now is any money that we owe our creditors or our suppliers for goods that we've brought on credit. So for an example, let's say I've bought £100,000 worth of raw materials. Now in this example, let's say I've already paid that supplier £60,000, but I still owe them £40,000, but I don't need to pay them until 60 days time. That's why we have trade payables at £40,000. Next up, we have a bank overdraft. This is just a short-term form of borrowing where you're able to spend more money than is actually in your bank account. So your bank account would represent a negative. Then we've got any other short-term debt, so anything else that the business may owe within the next 12 months. And then we've got accrued expenses. So think if prepaid expenses is expenses that we've paid for in advance, well, accrued expenses is something that we owe. So essentially, we're behind on our expenses or our bills. So let's say, for example, we're in January, but we haven't yet paid for our December rent. And then we have our non-current liabilities. Now, once again, non-current after 12 months, liabilities, debt we owe, put it two together. Non-current liabilities is any debt that the business owes that is not due until after 12 months. Now, the typical example you're going to see is a bank loan, which we know is a long-term source of financing. Now, there could be other examples such as any pensions, deferred liabilities, bonds, and so on. And then we've got equity. Now, equity isn't as simple as your assets or liabilities. Those are simple. We either own it or we owe it. It's either within the next 12 months or after 12 months. Now, cast your mind back to the balance sheet equation. The reason why it's called a balance sheet is because it should balance. Your assets are equal to your liabilities plus your equity. So if I'm going to rearrange that formula around, well, equity is just your assets minus your liabilities. So one way we could look at defining this is that equity is the owner's claim on the business's assets after all liabilities have been paid. Now, the key thing there is got something to do with the business owners. And another way we could look at it is the money the business owners are putting into the business. Because we've got two main examples, share capital and retained earnings. Now, share capital, another external source of finance that we learnt in Thing 2. What we mean by share capital is when the business issues new shares, i.e. selling new shares to investors in return for some investment to the business. So for example, I may have issued new shares and they may have all been bought for £150,000. Now that £150,000 cash going into the business would be your share capital. And the other is also our retained earnings. Now you might be asking, how has this got anything to do with the owners? Well, if you think about it, the profit belongs to the owners of the business. They get to decide whether they want to pay themselves a dividend or not. So when we look at the retained earnings, we've decided to keep that back into the business. So it's any profit the business makes that they want to reinvest and not pay out as a dividend. The next topic that we're going to take a look at in this revision video is one that students truly despise, which is the gearing ratio. Now, the gearing ratio is probably one of the trickiest calculations that you guys will need to do across the A-Level Business spec. But the reason why students hate this and they can't do it is because they don't understand what the balance sheet is. But hopefully by now you guys understand the balance sheet. Now, what the gearing ratio wants to tell us, out of the long-term funding methods the business has, how much of that has come from long-term debt? Because when we look at our long-term sources of finance, we've got either debt methods or equity. Debt is when I borrow money and have to owe that back. Equity is when we're bringing money in through the shareholders, either through retained profit or through share capital. And we've just looked at equity just within our balance sheet. And we've just looked at our long-term debt as well in our non-current liabilities. And what it wants to do is it wants to find the optimal capital structure, i.e. we don't want to be raising too much of our long-term funding through debt because that can be quite risky. Now, in order for us to calculate the gearing ratio, we really need to understand what capital employed is. And all capital employed is the total amount of capital a business uses to operate. So it's the capital the business will use for their long-term strategy about how they operate the business. And this refers to the long-term investments made in the business to support its operations and growth. Keyword, long-term investments. Now, how do we calculate capital employed? Well, the formula for capital employed is your non-current liabilities plus your equity. And this is why understanding the balance sheet is so important. Because we know what non-current liabilities are. It's any long-term debt that the business owes, obviously after 12 months. And the main example we just saw was a bank loan. And we know that a bank loan is one of the main sources of finance. But we've also got equity. And the two types of equity we have is share capital and retained profit, which are both long-term sources of finance for the business. Now, the other way you can calculate capital employed is that if you switch around that balance sheet formula to do the total assets minus the current liabilities. However, I would prefer you guys to remember this one, but it is also important to note this because they can ask you that for your exams. So, how on earth do we calculate the gearing ratio? Well, the formula for the gearing ratio is that we take our non-current liabilities, our long-term debt, divided by the capital employed times by 100. Because all I'm doing here, remember, the capital employed is a long-term funding of the business. I'm just comparing how much of that has come from my long-term debt methods. And gearing, going to be a percentage, so times by 100. But I've just showed you the formula as well for capital employed. So the other way we can look at the gearing ratio is taking the non-current liabilities divided by your non-current liabilities plus equity, all of that times 100. Remember, the non-current liabilities plus equity is your long-term funding for the company. All we are doing is seeing out of all of that, how much of that has come from your long-term debt methods. And as we've just covered, all of this information can be found on the balance sheet. So if your examiners are trying to throw you off, they may give you revenue, they may give you profit, gross profit, operating profit, net profit. You ignore all of that information because that is on your income statement. None of that has got anything to do with the balance sheet. So on the screen here, you can see a balance sheet. Our current assets are £80,000, non-current assets £200,000, current liabilities £75,000, non-current liabilities £150,000, and we've got equity there where share capital £25,000, retained profit £30,000. Now to calculate the gearing ratio, I don't need all of that information. I just need non-current liabilities and equity. So we ignore all of that other information. And remember, the formula for gearing, non-current liabilities divided by capital employed, also known as non-current liabilities plus equity, all of that times 100. So I'm just going to put in the information. We do 150,000 divided by 150,000 plus equity, 25,000 plus 30,000, all of that times 100, which gives me a gearing ratio of 73.17%, which essentially means for every £1 of my capital employed, 73 pence of that has come from long-term debt. So 73% of all of the capital employed is coming through long-term debt methods of finance. But is that a good thing? Is 73.17% too high, too low? Well, we've got some ways of categorizing these values. Low gearing is anywhere below 25%. And this means that we're not really relying that much on long-term debt. We're relying more on equity sources. A high gearing though would be anywhere above 50%. And this means we are heavily relying on long-term debt methods to fund the long-term strategy of the business. And then an optimal gearing, depending on the industry, anywhere between 25 and 50%. But let's give you guys even more notes on this. What does it mean to be highly geared? Well, as we said, first of all, anything over 50%. So majority of the business's long-term funding is coming from long-term debt, not that much coming from equity. I would argue no. I think having a high gearing can be quite risky, because if majority of your long-term funding is coming from debt, then that puts you in financial risk, because you have to pay off that debt, whether your business is performing well or not. Now, one of the reasons that a business goes under and goes bankrupt is because they're unable to pay off those debts. So let's say there was an economic downturn and you don't have enough cash within the business to pay off those long-term debts. Well, then that gives you the likelihood of going insolvent and puts strong pressures on your cash flow. So I would argue having a high gearing ratio is going to be risky. But that doesn't mean it's the end of the world. As I said, some businesses may typically have a high gearing ratio. Think of the housing estate industry. Most of that is paid through long-term debt in the form of mortgages. But how could a business reduce their gearing ratio? Quite simple. We'd either want to reduce the amount of non-current liabilities or increase the amount of equity. And the way you can start reducing your non-current liabilities, first of all, stop taking out long-term sources of debt, or you could potentially start to pay off any of that long-term debt. Another way we can do is start to increase the amount of equity. And remember, there's two ways: share capital, retained profit. So we could focus on looking at more share capital, issuing more shares, or we could look at increasing the amount of retained profit. So potentially the business focusing on a profit maximization strategy. And as well, if we want to increase retained profit, well then stop paying our shareholders as many dividends. But what about low gearing? Is this now a good thing or is this now a bad thing? Well, as we said before, remember, low gearing, we're looking at below 25%. And what a low gearing ratio indicates is that a business relies more on the equity methods than your long-term debt methods for its long-term financing. I.e., we're not really taking out as many loans compared to share capital and retained profit. But is this necessarily a bad thing to have low gearing? Because I've just explained there, having a high gearing can be considered risky. Well, actually, yes, having a low gearing can also be considered risky. The reason is debt isn't a bad thing. Having some debt can be quite good, but you want to have an optimal capital structure. You don't want to have too much debt in comparison to equity. So if you aren't focusing on these long-term debt methods to fund the company, well then that could potentially limit the amount of growth potential you have. And especially in these dynamic markets or markets which are required for you to grow quite quickly, then once again, this can be quite a bad thing. So how can a business then look at increasing its gearing ratio? Well, quite simple. Either you look at reducing the amount of equity, so potentially buying back some of the shares, or look at increasing the amount of dividends. Or instead of making lots of profit, focus on sales maximization. Or what we could do is we could look at increasing your non-current liabilities, so taking out more long-term debts. The next topic that we're going to take a look at in this revision video is also another calculation that students despise, which is the return on capital employed. But by now, you've understood what capital employed is. We understand that it's non-current liabilities plus equity. Now, what do we mean then by return on capital employed? Well, this time we're looking at a financial performance ratio that measures profitability. So whenever we look at the return on something, we want to consider the profit made. So essentially, all the return on capital employed is telling us is how efficiently can a business generate profit from the capital employed invested. Remember, capital employed, the total resources the business used to generate profits and represents the long-term funding invested in the business, which is calculated by taking your non-current liabilities plus your equity. So how on earth do we calculate return on capital employed? An easy way to help you guys remember this. The return sits on top of the capital employed because the return is the operating profit. It is on top of capital employed, and if it's profitability, you want to change it into a percentage, so you times it by 100. Now, of course, remember, capital employed can be expanded out into non-current liabilities plus your equity. Now this time, we're using information more than just from the balance sheet. From the balance sheet, this is where you get your capital employed, your non-current liabilities and your equity. But from the income statement is the operating profit. So we're going to need to know both financial statements. It's a good thing we've already looked at that earlier on in the revision video. So let's have a look at a calculation example. So as here, I can see I've got a balance sheet. I've already gone through those figures. And I've also now got an income statement where revenue, we've made £1 million, cost of sales, £200,000. So of course my gross profit, £800,000. My operating expenses is £750,000, which leaves my operating profit, £800,000 from the gross minus the operating expenses of £750, gives me an operating profit of £50,000. Interest and tax, £30,000. So my net profit, operating profit minus your interest and tax, equals £50,000 minus £30,000. To give me a net profit of £20,000. As we've said, for your return on capital employed, we need operating profit and capital employed. So the operating profit we know is £50,000. The way we calculate our capital employed is we do your non-current liabilities plus your equity. So return on capital employed, operating profit £50,000, capital employed, well, non-current liabilities is £150,000, equity £25,000 plus £30,000. Times by 100 to get your percentage, which gives me return on capital employed of 24.39%, which essentially means for every £1 of capital employed, the business is returning 24p on operating profit. But what does this all mean? Do you want a higher return on capital employed or a lower one? Well, of course, you want a higher one. Now, a higher return on capital employed indicates better efficiency in using our capital, i.e. using the capital, taking that and turning it into profit. Now, realistically, the return on capital employed will be very unique depending on the industry or the type of business. So you don't want to cross-compare against different industries. The only ones that you want to compare is against your own past data. So is it increasing or decreasing over time? And also against your competitors. Now, when we look at ratio analysis, both the gearing and the return on capital employed formulas, you have to know it is just quantitative data. So it can provide the business with real useful information, but it's not showing us anything to do with qualitative information. So keep that in mind when evaluating. It also relies on accurate financial statements. We have this issue in accounting of window dressing, which essentially we may look the accounts look better than they actually are by bringing potential revenue further back. So essentially revenue that I may record in next year, I'm actually going to record in this year so the operating profit looks a bit more healthy. Just a quick one, if you need a bit more support with your exam technique, such as how you improve your analysis, how to apply more within your answers, and how to evaluate more, well, I've created a free exam technique course that helps you with this. It also goes through the key answer structures that you need to follow for your exams, including those 4 markers, 8 markers, 10, 12, and those dreaded 20 markers. You can access this exam technique course for completely free using the link in the description. Back to the video. The next thing that we need to do in this revision video is we're going to continue our calculations, but this time we are looking at our HR performance, starting off with our labour productivity. Now you may have heard the term productivity earlier on, especially within theme 2. Now, the way we calculate labour productivity is that we take the output during a period of time, divide that by the number of employees, which essentially measures, on average, how many units are each employee producing. Now, of course, the higher the labour productivity, the more they're producing. The lower labour productivity, potentially highlighting efficiency issues, means that each employee aren't producing as much. So, as an example, I've gone really simple with the data here. I'm just going to give you everything that you need to know. Let's say our output over our previous year is 150,000 units and the number of employees that we had are 500. So what we would do is we would take that 150,000 units divided by our 500 employees for that specific period of time over that across year. We've been able to identify that our labour productivity is 300 units per employee. So over that yearly span, each employee on average is producing 300 units each. Now earlier on in theme 1, we looked at the concept of motivation. We looked at the theories, we looked at the financial and the non-financial methods. Now, to improve labour productivity, we're not talking about machinery, we're looking at labour productivity. The way we want to improve this is by motivating the workforce more, because they want to work harder, so typically productivity levels would go up. And if your labour productivity levels are going up, this is a clear indicator that the business is operating more efficiently, which can help reduce the unit costs. The next HR performance metric that we want to look at will be the labour turnover. Now, all the labour turnover is the rate at which employees are leaving the company. And the way we calculate this is we take the number of employees leaving over that period of time divided by the average number of employees. Reason we want to do average is because think we may be hiring employees as well in that period. So the way we once again want to calculate this, let's say I've been really kind and giving you all the data. I've given you the fact that the number of employees are leaving are 15 and the average number of employees that we have is 200. So all we do, we take the value of 15, number of employees leaving the business, divided by the average number of employees that we have in that period, which is 200, times by 100, which would give me a labour turnover of 7.5%. But they can be mean. They may not give you the average number of employees. So something which is really easy that we can do to calculate this, if we take the employees at the start of the period plus at the end, divide by 2. I know what you're asking, why do we want to divide by 2? It's because whenever we calculate the average or the mean of something, we add on how many we've got and divide by how many there are. So employees at the start is 1, employees at the end is 2. Therefore, that's why we divide by the 2. So for example, they've given you the fact that you've had 250 employees at the start of the year and at the end of the year, 240. 250 plus 240 divided by 2, which would give me the average number of employees during that period of time of 245. Now, the labour turnover is an important piece of performance data for our HR department because having a high labour turnover potentially indicates that your employees aren't that happy. And of course, if your employees are leaving the business, well, there's a good chance you're going to have to replace them, which means that you need to now invest more into recruitment and selection. And of course, that would increase the business's costs. But as well, if those employees are of specific knowledge and have got high expertise, well, you don't want those employees leaving because the likelihood is they're going to leave and join your competitors. So you have knowledge leaving your business. However, high labour turnover rates are typical in certain situations. For example, in seasonal industries, In jobs as well which require low skills, so you don't really mind those employees leaving because they're a lot easier to replace. And as well if you have limited career advancements. And the very last HR performance that we need to take a look into will be this concept of absenteeism. Now, absenteeism is the intentional absence of employees from work when they are expected to be in. And how nice, for you lot, you've got to learn two formulas for this. The first way we calculate absenteeism is that we take the total number of days lost due to absence divided by the total possible working days times by 100. Or the second way of doing this is that we take the total number of employees absent divided by the total number of employees, once again, times by 100. Both of these you want to express as a percentage. So once again, let me give you guys an example of how you would calculate this. I've given you all the data that you need. The total number of employees absent is 50. The total number of employees that the business has is 1,500. All you need to do, really simple calculation, 50 divided by 1,500 times 100 gives me an absenteeism of 3.33%. Now, ideally, absenteeism rates, you want them as low as possible, because if absenteeism got too high, well, that's going to cause more disruptions within the business, which of course begins to impact the overall productivity. And realistically, absenteeism is going to be high if your employees aren't happy and they have low levels of motivation. The very last thing that we now need to do in this revision video is that we've looked at these HR performance metrics. We just need to figure out, well, if we did have poor metrics such as poor labour turnover, poor labour productivity, how do we go about improving them? What strategies could we implement? Now, there are several different ones to improve labour productivity, turnover, retention and absenteeism. We've got financial rewards, employee share ownership, consultation strategies and empowerment strategies. Some of these should sound very familiar, especially when we looked at the financial and non-financial methods of motivation all the way back in theme 1. So we're just going to quickly recap these. Starting off with financial rewards. Now, when we think of financial rewards, think of Taylor's scientific management. Taylor believed that employees should get a fair day's pay for a fair day's work. So when we look at financial methods of motivation, this is purely extrinsic. This has got nothing to do with those intrinsic factors. So a couple of ways, we've got the piece rate pay, which is basically the more you produce, the more money you would earn. On the screen there, for every pen I made, I get £1. The principle is, well, to earn more money, you've got to produce more. Then we've got commission, which is typically your sales staff. So commission will be part of the money that you make for the business. So for example, if my commission rate is 10% and I sell a car which is worth £100,000, my commission would be £10,000. Then we've got a bonus. This could be a yearly bonus, good performance bonus, or just a Christmas one. Next we've got is a profit share. So fairly similar to the concept of a dividend, but rather giving part of the profit to your shareholders, you give it to your employees. And then finally, your performance related pay, either done in the short term or long term, which basically assesses how we're going to give the employee more money based on how they've been performing. Next up, we have an employee share ownership. Now, essentially, an employee share ownership provides ownership for the employees. Essentially, they will get shares of the company. Typically, you'll find this in your public limited companies, where the company would either give shares away to their employees or offer it at a discounted rate. So for example, instead of the employee receiving all of their monthly pay, part of that would go into buying shares of the business. Now, the reason why this would hopefully motivate the employee a little bit more is because they've got a sense of ownership in the business. They know for them to get more dividends, for their share price to increase with capital gains, they want the business performing better. So for the business to perform better, they've got to be working better. But the issue is with this, it sounds all good, but we know that share prices can fall at any point. Next up we have is our consultation strategies. Now we know our democratic leader loves a consultation strategy because they want to demonstrate that they care about the employee's input. They value the input that they have because they feel like their quality of decisions could improve. So what the consultation strategy demonstrates is that the business values their employees' input in decision making. So this could relate to even Maslow's hierarchy of needs. We're satisfying our esteem needs because we're showing the employees we trust them. Or we could look at Hertzberg's two-factor theory, maybe an element of job enrichment for those motivator factors. And finally, we have our empowerment strategies. Now, if we want to empower someone, we're giving them the power. We're giving the employees the autonomy so they take more control over their work and take on more autonomy in terms of decision making. So in order for an empowerment strategy to be successful, first of all, we want to provide training for the employees. We want to support their personal growth. And by doing this, once again, we show that we value the employees. We show that the employees are an asset to the business. So this could start to boost their confidence, their personal growth. They're happier within the business. Once again, the esteem needs of Maslow. And if we're feeling a bit more motivated, well then hopefully we start to work harder. Productivity increases. We don't want to leave the business because they value us. So labour turnover rates could also decrease. And they also don't want to take any intentional leave of absence, so absenteeism will also reduce. If you want to continue your revision with theme 3 topics, then I highly recommend you check out our video here on theme 3.6 Managing Change, because we're going to go through some key things that you need to know for your exam, including the causes and effects of change, identifying risks in change, and also go through scenario planning. I hope these videos have been helping you out with your revision. Thank you so much for watching, and I'll see you in the next one.